and remit it to CRA. So that would be my approach, just because I wouldn't want him to register if he was choosing, especially if he was choosing to stay under 30,000 for the purpose of not needing to be registered.
Wow, interesting. Okay, that's good to know. Do you think investors who have, different properties need to have separate bank accounts for each property? Do you think that makes a difference?
It can be beneficial in terms of tracking the income and expenses for each separate property. Because typically somebody's owning the properties personally, it's not a requirement that each property have a separate bank account, but for all intents and purposes, it's going to make it easier to track each property. If you do have, say, one account that handles all your rental income and expenses, you would just need to make sure it's tracked what is for what property, because when we're reporting it, we're reporting each property separately in the tax return.
Got it. That makes sense. Now, what about, should an investor form a corporation to purchase real estate? What are the advantages and disadvantages of doing that, of holding the property in a corporate name versus their personal name?
That's a very good question, and one that I get fairly often. So generally, there are limited advantages to holding rental properties in a corporation. The reason being is that there's a reduced tax rate for small business income in Canada that is 15% roughly. And that is only based on active business income. So rental income is considered passive, and it doesn't get that preferential low business rate. So if you're holding a rental property in a corporation, the income is going to be taxed at a much higher rate, and there will be incentive for you to pay it out to yourself personally, so that the corporation is not retaining the income and being taxed at a higher rate. So as a result, the corporation is really just flowing the money through to the shareholder, and in that case, there's the benefits then are limited if it can't hold the income in there. It would be similar to you just holding it personally. Now, that being said, there can be some benefits to a corporation holding real estate if, say, an operating company is using profits and funneling it to a holding company which invests in the rental property, and you're not needing to take money out of the corporation and get taxed personally on it. So if we're using pre-tax dollars, I mean, there can be case-by-case scenarios like this where we'll look at it and say, you know what, it could make sense to retain the properties in a corporation. In many cases, we would have a separate corporation so that the active and passive income are separate from each other. And then there could be other legal benefits if a lawyer considers that your exposure personally is of concern, then there can be benefits like that. But generally, there are limited advantages, and we would look at it carefully. But in many cases, holding it personally is easier and less costly, because you will incur more accounting and legal fees for a property being held in a corporation.
Got it. That makes sense. And I've also heard from a lot of mortgage brokers, too, that the banks prefer people to hold properties in a personal name versus a corporation name. They make it very difficult for people to get the mortgage in the name of a corporation unless it's an ongoing corporation that's actively making money. So, yeah, I think that definitely makes a lot of sense. Can you tell us a little bit about the HST and how that works when you purchase a new condo, whether you're planning on living there or renting it out as an investor? How does HST work in a pre-construction condo?
Sure. So there's a special program offered to people buying properties for living in and renting out, called the New Housing Rebate and the New Residential Rental Property Rebate. So the government will give a portion back of the HST paid in this special rebate. And it really depends on what province you're in Canada. But if you're in Ontario, there's a federal and provincial portion that you can qualify for, up to $24,000 provincially, and it will be 75% of the provincial portion of HST, and then up to $6,300 for the federal portion. However, it's phased out between market values of $350,000 and $450,000, and then above that, there's no federal portion, and it's 36% of the federal portion of the HST that's refunded to you. So at the end of the day, we do a calculation and figure out what rebate you're qualifying for and file to the government. It actually happens that both the GST HST New Housing Rebate and the New Residential Rental Property Rebate come out to the same dollar value of rebate. It's just that different paperwork is filed for each one separately. Now, what actually happens is if you're buying a property to live in, the builder is normally automatically filing for the rebate on your behalf and crediting the transaction so that you're getting the rebate through them. They're basically either including it in the price they already quoted you or adjusting the final statement of adjustments accordingly. Now, if you're going to be buying a property as a rental property, then the builder can't actually file that rebate for you, and you need to do it separately, in which case someone like myself can file it for you instead of the builder. So you need to communicate to the builder if it's going to be used as a rental property, because if they file for you and then it's later determined that's a rental property, CRA can come back and say the wrong rebate was filed. We want that repaid. And by the way, you owe us interest and penalty on the amount that that you received in error. Even though you're eventually going to file the same rebate and get the same amount back, hopefully, they'll still charge you that interest and penalty on the rebate that you were holding under the wrong application. So I actually have had a number of calls about this within the past year, and it's something that I always advise clients about.
Awesome. That's good to know. So if you are an investor buying the pre-construction condo and you're now going to file for that HST rebate, do you need to show any additional documentation, for example, like a copy of the lease? Is it okay if the lease is around for a year? Is it okay if it's 6 months? What are sort of the rules and regs about that?
Sure. Yes. That's for the rental property rebate. You need a lease that is a year-long period. Now, that lease could have started before the closing date, so it could be started during the occupancy date prior to closing, as long as you have a lease agreement that goes past a year. There's some other standard documentation like the purchase and sale agreement, the statement of adjustments, other standard documentation that we need. But other than that, those are the only documents that need to be filed with CRA. One other point that I want to bring up, and this is very important, is that if somebody is buying something pre-construction and are flipping this property, they're not going to qualify for the rebate. And this has actually been very closely watched by CRA lately. They're going after a lot of rebates, which people are claiming or have already received. And then they become aware that somebody flipped it, either lived there a very short time, let's say under a year, and then flipped it. Because to qualify for the rebate, it needs to become the primary place of residence for either yourself or a close relative to qualify for the new housing rebate, or it's being rented out as a rental property. But if you're flipping within that year period, you're not doing either, and CRA is going to deny the entire rebate.
Wow. Okay. That's good to know. Can you tell us a little bit about how HST works with a renovation project? So if someone's doing a significant renovation of their home, can you tell us the difference between if it's the significant renovation on a principal residence versus a significant renovation on a real estate investment property? What sort of implications are there for HST and getting rebates in those scenarios?
Sure. That's also a very good question. So the rebate for what is called a substantial renovation, and this needs to be considered a renovation 90% plus of a home or condo for that matter. That would usually involve replacing the walls, floors, gutting the place essentially. And in that case, CRA considers it really to be like a new home, and they'll actually provide the what they call the new housing rebate through similar paperwork. However, you actually need to provide a schedule showing a summary of the expenses incurred, and a similar calculation goes. However, one thing I should point out is that the maximum rebate in most cases would be $16,080 because there was no HST paid on the land. They've limited to that amount. So it's a lesser rebate. However, there's a lot of home renovation going on, and people are often not aware that they can qualify for that rebate. Now, if it's a rental property that's being renovated, it's a bit of a different situation because CRA is going to require you to assess that the fair market value of the property at completion is like a new property, and they're going to basically require you to self-assess the HST on that amount and remit it to the government. And then you could claim the input tax credits on the cost that you put into the renovation and the HST rebate. But in this housing market, I find that a lot of the time you're coming out behind when you need to let's say, assess HST on $1 million. Let's say that's the fair market value of some property you just renovated. And then if you're claiming input tax credits on the costs and even the rebate, you're often coming out behind on that HST. So it can be to somebody's disadvantage to be kind of substantially renovating and filing the rebate accordingly. CRA could require it, though. If you've essentially redone a home, they could say, well, you've redone a home and you need to self-assess. So that's the general way things are done with that.
Wow. It's all so complicated. Oh my God. Very interesting. Can you tell us how HST works if you're purchasing a home built by a builder? So in the North Toronto area, there's lots of builders who sort of, take a bungalow, bring it down, and build up a new house. So how does HST work if you're purchasing a house built by a builder?
So a house built by a builder. So you mean that the builder has they built the home themselves and then they're going to be selling it to you? Is
yeah, exactly.
The scenario?
Yeah, they're kind of like a house flipper. I mean, when I say builder, they're not sort of, massive corporations. We're just talking about sort of an individual builder, we'll say quote unquote builder, that, has bought a bungalow, knocked it down, and is now completely changing that, property and building a brand new built house. So how does HST work in that scenario?
So typically that's going to fall in within resale, and under the resale homes, you would not pay HST. So as a buyer, if they're selling it to you and they are an individual builder who's not registered with Tarion and going through the process of saying we're selling you a new home here, they would either charge it to you as selling you a new home, but in most cases this is going to be a builder doing a resale, like this would be a resale. So that would be my approach to that transaction. And one thing I should mention on the previous topic we discussed is that with renovation, to be considered substantial renovation, then it would need to be that 90% plus. So if you're doing a renovation on a rental property, it would be, if you're doing 90% plus renovation, but if you're just, doing half the house or something, then it wouldn't be considered substantial. So that's really the test, is whether it's substantial or not.
Got it. That makes sense. Do you think that parents should consider purchasing a rental property in their children's name?
No, that's generally not advisable for a few reasons. One, if they're minors under 18, there's going to be attribution of any income from the property. So it's not going to let somebody avoid paying tax on a property. And secondly, there's transferring property to a family member who, if it's not your spouse, like you're transferring to them at fair market value, and it's going to be a deemed disposition. When somebody is deciding to put their adult child as a joint owner on their home, there's really a deemed disposition of half the value of that home is now occurring, and there'll be a tax consequence for that. So in that case, I mean, there's going to be a tax consequence that arises even though no cash has changed hands. So that's why you have to, anytime there's planning around acquiring property within the family, it's definitely something you want to talk with an accountant about to avoid undesirable tax consequences.
Right. That makes a lot of sense. Is there anything else you think our listeners should know about when it comes to accounting and real estate?
Sure. I would say one thing is to watch the budget, which should be coming up very soon from the federal government, to see if there's any changes. One thing that has been whispered, and we don't know if this would occur, is that there could be a change to the capital gains rate in terms of the percentage that's taxed. May not occur, but there's been talks that is some area where tax could be changed, because if they're cutting tax for lower income earners, they need to be adjusting tax elsewhere. Another area would be just to be more attentive to property flipping, because CRA is watching it a lot more. It's a very political matter now with the markets the way they've heated up. So just if you're going to be claiming something as your principal residence, just ensure that you're living there for a certain time period and then later selling, or filing the right rebate. Whatever you're doing, just make sure that you're adhering to whatever the guidelines are. And then and in general, if you're acquiring property, it's always good to talk to an accountant and or lawyer about the long-term goals to make sure that the appropriate plans for passing on that property within the family maybe is done appropriately, so that the end strategy is there in terms of how assets are passed on.
Perfect. That sounds great. Thanks so much, Daniel. I always like to ask my interviewees, if they rent or own and which part of the city they live in and why. Can you let us know what your situation is?
I live in the Yonge and Eglinton area.